Hello everybody and welcome to this week's edition of Money Matters, because I'm sure you know money really does matter. Now, what I want to share with you this week is the top 5 reasons why property investors pay too much tax. But perhaps more importantly, what can you do about it? And here's the sad thing, they don't even know. Okay, let's kick off with number 1. Number 1 is Section 24. What's Section 24? I'm sure you know about this, it's well publicised, and it's the limitation on the amount of tax relief you can claim on your mortgage interest payments if, for instance, you're a high rate taxpayer and you own the property in your own name. Now, some people have got the level of education and they know that buying through a limited company is one way of making sure that you are not subject to Section 24, because of course, limited companies are not subject to Section 24. Well, that's fantastic. But what most people do not know is that properties like this, check this one out. This is Synergy House. This is our head office. It's a 10,000 square foot commercial building. There are, as well as certain types of ownership structures that gives you exemption from Section 24, there are certain types of property that are not subject to Section 24. So another way that you could not be troubled by Section 24 is by not having buy-to-lets. Okay, this is a £1.4 million office, 10,000 square feet, so it might be a little bit too large for your first purchase. So how about this one? This is St Helens down here in Doncaster. So this is, well, it used to be a barber's shop, so accommodation above it. What we did, we converted it into 4 flats. Well, hang on, Paul, 4 flats, that's buy-to-lets, that's subject to Section 24. Well, actually, no, it isn't, because these are 4 serviced apartments. Some people call them furnished holiday lets, but obviously Doncaster is not really a holiday location. So FHL is a subset of serviced accommodation. Who stays there then, Paul? Well, that is contractors. That might be bricklayers, it might be locum doctors at the local hospital. It's people that are in Doncaster. They're going to be here for a while, but they're not here permanently. So they do not want a long-term AST, assured short hold tenancy. What they want is accommodation by the night. So in addition to exempting yourself completely from, I mean, it looks like a flat, doesn't it? It looks like a house converted into 4 flats. That's why it's got 2 front doors. But as well as exempting you from Section 24, you get huge other tax breaks that I'll come on to. So learning about the different kinds of property that are subject to or not subject to Section 24 is a really, really important part of being a savvy property investor that wants to look after their money. Because as you know, money matters. Okay, and the final one we're going to take a quick look at in this whistle-stop tour of properties that are not subject to Section 24 is this one. This one is Springfield House, again here in Doncaster. It's a commercial conversion we did, but it's mixed use. The ground floor is still an office. Upstairs, we've put 5 flats, 4 1-beds and 1 2-bed. Now, again, these are serviced accommodation units. So regardless of ownership structure, you could own this building in your own personal name and it still wouldn't be subject to Section 24, and you make a ton more money. So you've got less tax, higher income, because ground floor, office, first, second and third floors, they look like flats, but they're not treated as flats because of the way that they're used. So if you want more money and you want to pay less tax, you need to learn the ins and outs of Section 24. Okay, on to number 2. We're now on stamp duty. So, residential property. Residential property, what is the top rate of residential property stamp duty in the UK? Trick question, actually, because the top rate is 12%, but then you've got the additional rate if it's a second residential property, and it's different. So in England, it's an extra 3%, so that takes you from 12 to 15%, and in Scotland, Wales, whatever, it's an extra 4%, so that moves you to 16%. Now, clearly, that is a massive consideration when you are buying a property. So how can you mitigate that? Well, again, you can use a different kind of property. But what I want to do is I want to show you these two. These two here, these look like bungalows, smell like bungalows. And the solicitor that was doing the transaction for our wonderful masterminder, Yuri, said, these are bungalows. These are subject to the additional rate, to stamp duty, to whatever else. And he was like, whoa, no. I bought these from auction. We actually bought them from the prison service and they were offices for the dog handling unit, I think. So their planning use class was actually commercial. And because Yuri was a bright guy and he knows what he knows and he's been educated on the Touchstone mastermind, he knew he should not be paying stamp duty. Now, stamp duty is what's called a self-elected tax. So if you tell your solicitor, this is what you need to do, solicitor, then they'll do it. If you leave the solicitor to their own devices, they are likely to make mistakes if they don't understand the more advanced property strategies that a clever, savvy property investor is likely to use. So in this case, perfectly legitimately, you already paid 0 stamp duty. Why? Well, because, look, here is the residential stamp duty table. See? Look at the different bands, and once you're above 1.5 million, you're at the 12%, and then if it's an investment property or a second home or something, you've got the extra 3 or 4% surcharge on top of that, so either 15 or 16%. But these bungalows were actually were commercial property. He actually did a commercial conversion. That's not really the point of this video. He converted them into residential, to a 1 bed to 3 bed, whatever. But that's a different story. He made about 100 grand per property. But anyway, the point being, if he hadn't known what he'd known, he would have been subject to the 3% stamp duty on both of these, and the combined purchase price was around about £130,000. So he would have been charged £3,900 of residential stamp duty incorrectly on commercial buildings. How about that? And he actually came to me after and said, you never guess what, Paul? The first solicitor I was using, they were trying to charge me residential stamp duty. But I know because you told me that there is 0 stamp duty up to £150,000 on commercial. Oh, that's interesting. So here is the commercial stamp duty table. Look. Nothing up to 150,000, between 150,000 and 250,000, £2,000, 2%. Then anything over that, 5%. So the maximum rate of commercial stamp duty is 5%. Imagine the savings you get when you get to bigger and bigger units. Now, I just want to go back over there for a second to show you something. Okay, so to finish off, point number 2, which is all about stamp duty, I want to talk to you about, come around here. If you're going to buy a house like that, if you knew what you were doing and you were planning ahead, could you get that house on a commercial stamp duty rate? No, Paul, that's not possible. Really? The Sunday Times actually interviewed me about this, and the people that were interviewing me were shocked. So that nice house behind me, that's actually my house down here in Doncaster. If, before you buy it, you've got planning permission in order to turn some of the property into a home office, you're gonna, the business is gonna pay for it, and so you've actually, and customers are gonna come and seat you in it. And in a big house like this, you probably want to be able to work from home anyway. I mean, that's a big part of what's happened during the pandemic. A lot of people working from home, and maybe you've even got 2 or 3 staff coming in. So that's a proper full-on office. So if you've applied for and got planning permission before you buy it, well, suddenly you've got on one title, you've got some commercial property and some residential property. Okay, so what happens now, Paul? Do you pay the commercial on the commercial bit and resident? No, it's now called mixed use. So look here, this is the mixed use stamp duty table. Look, it actually says it there. So if you've got some residential and some commercial, suddenly the whole property is subject to commercial stamp duty. Wow. But Paul, how can you get planning permission on a property before you even buy it? I don't know if you know this or not, but you don't actually have to own the property in order to get planning permission. I mean, you could, in theory, put in planning permission on Buckingham Palace. I'm not saying you should, probably lock you up in the Tower of London or something, joke. But you could. You do not need to own a property in order to apply for planning permission. But let's say you were going to go and buy a block of flats in London for, I don't know, £21.5 million. So to keep the numbers easy, let's forget the little bits at the beginning, and let's say you're just paying 15% on 20 million. Well, that's 3 million quid. But if you took one of the shops on the ground floor and turn it into an office or a laundrette or something, and it's all on one title, well, now you've got a mixed use property. So the maximum stamp duty is now 5%. You go and do the same thing, and instead of being 3 million, it's 1 million. You just saved £2 million for about £300-400. Well, that should be a bit more than that. But you've going through the planning process for, a few £1,000s. Of course, you could save a couple of million quid. So the more expensive the property, the more important it is that you understand stamp duty, how to mitigate it, multiple dwellings relief. There's all sorts of reasons why educated property investors do not pay anything like what amateur turn up, do it for the first time, I'm not going to pay for any education, I'm just going to have a go, property investors pay. So that is number 2, that is stamp duty. Hope you are liking these tips. Okay, let's go to tax number 3. Tax number 3 is the lovely, or not so lovely, VAT, value added tax. Now, I'm sure you know VAT on pretty much most things is 20%. And if you're doing an extension at the house, and the reason I brought you around here is we've now got full planning, we've done all the party wall, we're doing a big extension over there this year. And that extension doesn't have to cost us this much, but we're probably going to spend about £300,000 on it, maybe even go mad and spend £400,000. So let's say we spend £400,000 on it, we don't know what we're doing. Well, what's going to happen to us is we're going to get charged 20% VAT, so 400,000 plus 20% is £480,000. Ouch, that hurts, doesn't it? Little stingy £80,000 VAT bill on top of everything else. However, if you know about this, look at this HMRC document. VAT for builders. Does what it says on the tin. I have talked to many builders over the years. None of them have ever known about it. And if you read through it, there are various scenarios in which you pay 0% VAT, and there are various scenarios in which you pay 5% VAT, one of which is that. But you have to know about it. Of course, your builder won't, your accountant won't tell you, and you can't reclaim the 15% VAT. The builder's got to charge you 5% VAT. So instead of £80,000 on that VAT on that extension behind me, I'm going to be spending more like £20,000. So just by knowing what I know and being able to read documents like this and having the experience that I've got, as have many people in the Touchstone education community, I'm going to be saving £60,000 on an extension. Think about that. Now, I want to take you back to Yuri again. Before he joined the Touchstone Mastermind, on the same project that I was telling you about, he didn't know until we shared it with him as part of the education program. So do you remember he bought these bungalows off the prison service, and they were one-bed bungalows, but they'd been changed into offices? But he made them bigger. He changed them from 1-bed to 3-bed. As such, they qualify for 5% VAT. And on this one project, on this one single project, he saved more than £8,000 of VAT just because he knew that. He'd been a builder for 17 years. So I set him some torture homework. I said, Yuri, go back over the various projects that you've done, for your various sort of investment, and work out how much VAT you've cost yourself by paying the wrong amount over the years, because the rate you should have paid was 5%, and what you've actually done is paid 20%. Do you know what he told me? He told me over the last 17 years that had cost him personally £110,000. Because it's not like the VAT man's going to phone you up and say, oh, Yuri, Paul, you actually paid too much. We've checked, we've been through all the documents for you, and you've accidentally paid 15%, so we're going to give you a massive rebate. Now, the slight silver lining in this particular cloud is if you have made a mistake, you can go back, but only for 2 years, not for the rest of time. So you can go back and correct that, but not as easy as it sounds, because you've got to go back to the original contractor that did it for you. You've got to get them to re-invoice it. They've got to correct their VAT records. So it's going to be a palaver. But if it's a 20, 30, 40,000 pound rebate, maybe offer them 5-10 grand and, split the difference, because it's going to be a total pain for them. You can go back, but more importantly, the rest of your life starts today, doesn't it? You didn't know what you don't know, you now know. If you understand this for the future, and if you do lots more millions of pounds worth of projects in the future, it's going to save you an awful, awful lot of money. And that, my friends, is value added tax. 20%, 5%, or even 0%. How do you get to 0? Well, I don't want to spoon feed you too much. How about you read the guide and work it out for yourself? Number 4. I actually got it right that time. So, number 4 is structure. Now, I don't mean building structure, I mean corporate structure. Many accountants over the last few years have been sort of encouraged, trained, directed, whatever's the right word, because of Section 24, to tell you to buy property in limited companies. Very often, that is wrong. It depends what kind of property it is, it depends what your objectives are, and it depends what other things you want to achieve at the same time. The main thing, there's various kinds of structures. You might have heard about things called SPVs. That just means a special purpose vehicle. That's not actually a limited company or an LLP. It's just an entity set up for a particular purpose. So for the sake of this discussion, I just want to encourage you to read a little bit about and be aware of LLPs, limited liability partnership. Why would you want an LLP as opposed to a limited company? Well, I always say there are 3 main reasons. Number 1 is, if you like the idea of a cheeky little Maserati and you don't want to be paying company car tax, benefit in kind through a limited company, here's the news. You can actually have one of those beasts, and it is not a benefit in kind as long as you've got a legitimate business. So if you had some properties and you're collecting rent and you're doing renovations through an LLP, each partner in that limited liability partnership can have one of them tax-free. It is not a benefit in kind. So it isn't going to increase your income tax bill. You can put all the repairs, all the maintenance, insurance, road tax, all that stuff through it. If you want the fuel as well, there's like a charge table and it'll cost you X £100 a year. So you will pay a relatively small amount in fuel. But what else does it do? That depresses the profit of your LLP because you're paying for all the running costs of that car through it. And it is a major benefit to you, and it is completely and absolutely totally legitimate. So whether you want one of them or whether you prefer, I don't know, one of them, because that is mine. That's a C63 AMG, 500 horsepower, and how can I put this? It's fun! I enjoy it. I really do enjoy it. And I enjoy it even more knowing that the tax man is paying a major part of its running costs. Don't know if it's just me, or would you like to get some of your hard-earned back from the tax man that you've paid him over this many a last year? So next, inheritance tax. Now that's a moderately complex subject. So what I'm going to do is I'm going to tell you this. If you've got assets in LLPs, buildings, properties, you get major tax advantages from an inheritance tax point of view, from an estate planning point of view, versus limited companies, in my view. But it is a specialist subject. You need the right advice. Get yourself off to see an estate planner. Sadly, 75% of the people in the UK don't even have a will, an up-to-date, relevant will, never mind advanced tax planning, LLPs, estate management plans, and all the rest of it. So just a heads up, LLPs, in my view, are better for that than limited companies. And number 3, we're going to segue into number 5. I got the fingers right that time, didn't I? Number 3, we're going to segue into number 5, just to prove it wasn't a fluke. I did it twice in a row. The third reason that LLPs are ridiculously superior to limited companies for this purpose is capital allowances. Now, you've probably heard me talk about this before. Let's take some practical examples of capital allowance surveys. So this is where you buy a building that is where capital allowances, or part of your annual investment allowance, is permitted. And broadly speaking, in property terms, that's commercial property and also service accommodation, a subset of which is furnished holiday lets. Look at this survey. I did a video about this one a couple of weeks ago. This is Synergy Houses. The capital allowances on that were just a little bit more, about, I think it's 520 something thousand. So let's call it £500,000. So that means the entity that owns the building can earn, round numbers, £500,000 tax-free. This is Larina. This is our new villa in France. The office qualifies because it's commercial. The one in France, it's not even in the UK. It is in France and it qualifies for UK tax breaks. How about that? Even after Brexit. Larina, we've got the draft capital allowances survey here for as it is now, but we need to add on what we're spending down there in the south of France. So in case you've never seen my house in the south of France before, here it is. And as I'm speaking to you literally now, we're replacing all the air conditioning in the whole house. Because the elderly couple that had it before us, they only had 2 rooms which were air conditioned, which is like, what? It's a 6-bedroom house. We turn it to an 8-bedroom house. We need more than 2 rooms that are air conditioned. We're all going to die. And we're also replacing the ground source heat pump for winter heating. So, that alone, I think those 2 contracts are worth about £35,000. So roughly, by the time we've finished, the amount of capital allowances on that property, then going to be closer to £1 million. So just 2 of our properties are going to give us £1.5 million of capital allowance. What does that actually mean, Paul? What it means is that because of the extra tax breaks announced in the budget this year, the annual investment allowance was extended for another year at £1 million per person. So you and me, each of us can earn £1 million tax-free. So with those 2 properties, plus a number of other properties, Annika and myself, my wife and I, will easily get to £2 million of capital allowances in this year. That means we can earn £1 million each completely tax-free, as long as it's income tax. The way we do it is we put properties like this into LLPs. You can even put them in your personal name if you want. And that means profit from an LLP is subject to income tax. Now, normally people will say, well, that's bad because income tax is high and dividend tax is relatively low, except if you've got millions of pounds worth of capital allowances, which we have. So that means in the case of the LLP, if there's £2 million profit in the LLP or your personal name or whatever, you can literally put it on your hip tax free. That's the power of capital allowances within an LLP or within your personal name. Conversely, if it's the limited company that owns it, it means the limited company doesn't have to pay corporation tax on the £2 million, which is still good. Because you're going to save 19% on 2 million, in my example. 19% on 2 million is 380,000. So you've saved that. So you've now got £2 million locked up in your limited company. So if you want to spend it, you've got to get it out of your limited company. How are you going to do that? Well, probably after you've done all the other things you can do, the majority of it is going to come out as dividend tax. So, you're going to be subject to dividend tax on it. So there's no corporation tax, but the upper rate of dividend tax, which obviously if you're going to rip out £2 million in 1 year is, 38.5%, I think. I mean, if you want to check the exact number, go talk to an accountant. But for the sake of a round number, it's knocking on 40%. So 40% of 2 million is £800,000. Now, it's not quite 40%, so let's just throttle it back a bit, get your calculator out, look up the proper number, but it's roughly £750,000. So having these properties, just this office, just our house in France and the other properties that we're going to use to get to the £2 million, if we had them in limited companies, by the time it's in our pocket, that is a £750,000 in just 1 year decision. So I hope I've convinced you that learning about tax in various ways as it pertains to property. So we talked about Section 24, the ins and outs, how to do that. Stamp duty, different kind of tax. VAT, different kind of tax. Structure, different tax implications and tax benefits for things like that car. And number 5, capital allowances. They're all very, very different types of taxation. And your average property investor, your average person, not their fault, just don't know, doesn't understand that there are even decisions to make with regard to these various categories of tax. Therefore, they don't even have the conversation with their accountant. So to make sure you get the next level of detail on how can you do this to your advantage, click on the link just under this video and that'll take you to my 4-part series. It's free. Stick in your email address and straight to your inbox. You're going to get 4 videos, one after the other, a few days apart. So you've got time to sort of digest about advanced tax strategies to benefit you as a hardworking person that's making some money that wants to become wealthy. If you want to reclaim your time, I think you need to learn a little bit more about how to manage your tax. So, as always, please subscribe to the channel if you're not already a subscriber, and please just tell 2 of your mates about the channel because I'm keen to get this message out to as many people as possible. Hope you've really enjoyed this week's edition of Money Matters. As always, you've been wonderful. I've been Paul. See you next time. Bye-bye for now.